we have done ground up. I would call Reliant an opportunistic operator. We've done ostensibly everything there is to do in self-storage, but our sweet spot, Adam, really is value add deals. So, and just as a quick aside, we should probably do what is a value add deal in self-storage. But our sweet spot and where we found the most yield over the years has been value add opportunities in secondary and tertiary markets. And I would say out of the 10 deals a year we generally do, maybe one of them is a ground up development. I don't know if there's one. I mean, look, it's back to the people, and the team that's running it, right? So we have a great team at Reliant. I think it starts with acquisitions, right? Understanding properties and markets that will support the business plan that we're trying to enact. For us, our secret sauce, and it's not really a secret, but where we've had the most success is these forced appreciation plays, right? And Adam, if you think about real estate investing and people trying to predict what the future is going to be and where cap rate's going to be in 5 years, I don't know, and you don't know, and nobody knows, right? So what you're trying to do is, with a value add play, if you can control NOI growth, if you can control the profitability of the facility, then what happens with cap rates in the future, it's irrelevant, right? It's either going to go up or it's going to go down, and whatever happens is going to happen. But if we can grow profitability of the facility, generally, it's going to be worth more in the future. And so for us and our investors, that's what we subscribe to. In an up market, in a down market, it doesn't matter. It's NOI growth. And so that's where, for us, the value add play really makes sense, is how do we generate more NOI year over year than the year before? And if we can do that, that's the secret sauce and the success that we've had. And look, over the last 10 years, like many operators in any asset class, there's been a lot of tailwinds pushing, right? Cap rates have been compressing. There's a lot of capital in the space. Real estate has done very well. But again, in an up market or a down market, if you're consistently producing NOI growth, that's all that really matters. Let's pull on that string a little bit, right? Let's say, Adam, you come in and you invested $100 million in self-storage, and 5 years from now, cap rates rise 200 basis points, right? So your values are coming down. But if your cash flow is there, who cares? Refinance the debt or put some long-term vehicle on that thing where you sit in cash flow. And that's true of everybody, right? I mean, if you think of it from an investor standpoint, no one wants their cash back, right? I mean, that no one is too strong a word, but most people just want the cash flow. When our investors exit a property, what do? They want to redeploy that capital they just made, right? So again, back to the Warren Buffett long-term model, tax efficiency, don't lose principal. And if you can just keep rolling and use the power of compounding, that's where the true wealth is created. But that's how we look at the world. Is although investors ask us, and I already gave you that topic as a discussion, they want you to tell them what happens in 6 years. I don't know, and nobody knows. But what we can assume is, if we can hit these metrics, then generally it's going to be worth more then than it is today.